Good evening, everybody. Uh, okay, we're shifting back to option strategies. And a lot of people have asked me in the past, especially when I'm really aggressive, that I can go from 17,000 and 4 months later be at 170,000, what type of strategies I use, which was a combination of uh, options trades as well as uh, futures trades. So we're going to go back toward the option strategies, and people kind of wanted to have it narrowed down of which strategies work the best. So what I do is when I'm analyzing the market or analyzing for an option trade, my first criteria, which way is the market moving in general? Obviously, you want to be heading in the right direction of the market. Is there a signal and pattern? Then we get down to how much time do we have to expiration? Now, I'm using the terms expiration for the monthly options. There's a lot of people in the options room that trade the weeklies. So the only reason I don't trade the weeklies is because I just don't have time during the day to keep watching or keeping up with the trades. On an options or a monthly expiration, at least I've got a time to do my strategies. So that is a perfect segue to say one option strategy for one person may not be the right option strategy for the next person. And so that's what we're going to kind of get into is which option strategies work the best for specific uh, chart patterns. And then you've got to decide which option strategies work the best uh, for your time frame or your nature. I know a lot of people in the our options room. Some of them trade very quickly on spreads, weekly spreads. So it all depends on what strategy you want to work. What's the appropriate entry confirmation to be sure that you're buying the options at the appropriate time, and then which options. And so we're going to try to get into most of this. This is going to be kind of the Cliff Note version, but we're going to be over the next few weeks going through going through details in which strategies work the best and which might be the best for you. Now, if I'm doing different strategies, I usually break it down to if there's 4 weeks or so before the next expiration. Oh boy, is everybody getting those chimes? We haven't been able to figure out how to do that darn thing. Um, if you're getting the chimes, go up to the very right-hand screen or corner of your screen, and there's a gear up there. If you hit that gear, a box will come up, and the top thing is audio notification. Unclick that and uh, see if that works. It was driving me to drink, and it didn't change. All right. So, all right, good. So if I've got 4 weeks before expiration, I'm usually just going to be buying the calls or puts. But what most people have a misconception of is that if a stock is going up, it's time to buy the calls. If a stock's going down, it's time to buy the puts. That may be true approximately 20% of the time. The other trades that I do are the debit spreads, which is usually anywhere from 2 to 3 weeks out on average. And then the final week, I'll do a credit spread. They don't make a whole lot of money, but the probabilities of making money with them are extremely strong. So those are kind of the my parameters as far as what I've set up for myself, which always seem to have worked. Also, there's different strategies. If you're going long, and I'll just use the long side tonight, you could either be buying the calls or selling the puts, which is meaning you're thinking everything's going positive. You can buy call spreads, or you can be selling put spreads. So those are the type of strategies that you want to kind of, and I say that because that's about as complicated as I want to get on my trading strategies. Now, there's a lot of people that like to do the condors or the butterflies. That's great. It all depends on how much time you want to spend setting up your trades. Mark, that's which broker is the best for Options USA? That's more of a question for out here in the room. Let people give their opinions. Yeah, I use Thinkorswim also. They seem pretty good. So if we've got gaps confirming patterns, or we have big breakout gaps, we're going to try to analyze what to do. So when we're doing our analysis, the benefit we have with candlestick analysis is we can pretty much analyze the direction of a move, pretty much the timeliness of a move based upon where the resistance breakout levels are, either on a pattern or a signal. And we can also, with some of the patterns, see what the magnitude of the move is. And the magnitude of the move is important because if we're going to do a spread, we can be buying at one price and selling at what we expect to be the top of that price move and get much better beneficial returns than just buying calls outright. Will you take number 4 into account, determining whether to trade a debit or credit spread? Will you take? I don't understand what that means. Usually it's the time factor. Implied volatility, no. The implied volatility is already going to be built into the charts. Everything that we see on the candlestick chart has everything already built into it. So I don't pay attention to implied volatility, because if we've just come out through 4 months of a huge fry pan bottom, which didn't move very much, that implied volatility is not going to have anything to do with what the next move would be on a breakout. So I don't use the Greeks. I don't use implied volatility. What I use is the chart tell me what does human nature usually do in these situations, in these patterns. So again, with the magnitude of the move and how much time do we have to expiration, allows us to make decisions on what type of strategy we want to use. So those become the factors. And the one screen that I didn't put in here is not only do you want to figure out what the price move or what the direction of the move is going to be, but you want to set up the option strategy that makes the most sense math-wise. The math is very important. There's going to be a lot of times where a stock goes up, but the math doesn't make sense based upon what the price of the option is in the time frame. William, no, I don't use delta. Again, all that information is built into the candlestick chart, and once again, the delta is not going to be important based upon its calculation if you're coming out of a fry pan bottom that's been trading flat for the last 3 months. Also, when we know what creates a new price move, gaps are one of your major factors. Remember, the Japanese rice traders utilized the candlestick signals and gave the explanation of a gap or a window is that after a candlestick signal, a gap is telling you exactly what they're planning to do after that reversal signal. They're planning to buy it pretty hard, and it's got probabilities of strong price moves. So anytime I see a gap, especially coming out of a fry pan bottom, I know there's going to be more upside. I know that when I see a scoop pattern and it gaps up out of that scoop pattern, there's going to be more upside. Are we talking mostly about using options around earnings? No. No, options are just a method to buy whatever stock you're looking at. Everything else has to be taken into consideration. So, I'll do one. Which one? After we do this, we're going to go to some live charts to kind of show the illustration of how gaps help you out, especially around earnings time. Not so much, or not only to make big profits on the upside, but limit your losses on the downside. Does the size of the gap matter in your decision making? Yes, I might not buy on this day, but this coming out of this fry pan bottom, this gave me the information that I wanted to have. Is that when they came out of this fry pan bottom, the enthusiasm stepped in. Then all we do after, this dark candle said that they aren't buying, but this told us something very valuable, that there was a whole new dynamic in this price trend that we want to wait and see when the profit taking of that day is over and then be buying. How is Vega? Heron, if you go back to the simple explanation or definition of a candlestick signal, which is the accumulative knowledge of everybody buying and selling during a particular time frame, that usually going into earnings, probably people that are a lot more in tune with what's going on in individual stock are either going to be buying or selling based upon their knowledge. So usually the smart money, if things look good at the earnings, they're going to be buying. Now, are there surprises? There definitely are, but I've discovered through the years that every time I get hit with a negative surprise, I've already been paid off with 4 or 5 times that amount of positive surprises based upon what the chart was already telling me. Let's see. Well, Ed, it doesn't matter. The gap, the magnitude of the gap doesn't matter. It can be just a small gap, but if it's coming out of a pattern, it's telling us there is a new dynamic in that stock, and in this case, this should be probably moved up a little bit. It's breaking out of a resistance level, or this resistance level. It tells us there's a new dynamic. Remember, the gap up tells you there's still enthusiasm, or there is enthusiasm coming into that price move. And if it's occurring right where we can see a pattern, there's our slow curve, there's our fry pan bottom, and there's our breakout with a gap up through the breakout of the fry pan bottom as well as the resistance level. Anytime we can analyze a pattern, and a breakout level, that is what creates the entry strategy at the right timing, that you don't have to be sitting waiting for something to happen. You can be buying right at the appropriate time. So knowing that, if we know what should be happening coming out of a fry pan bottom, we have expectations that it's going to trade positive. Are we always going to get huge moves like this? Definitely not, but this is where my big money is made, is buying based on what the pattern is telling me and having the opportunity, not the opportunity, but the probability of being in a situation where the move is huge. Okay, let me, when you are determining the market trend for a specific equity, which moving averages are you using? You'll see them all in these charts. The moving averages that we use are the 50, which is the blue line, simple moving average. The red line is the 200-day simple moving average, and the gray line is the 20-day simple moving average. Now, those are what we have in our charts because every money manager in the world uses those to make their decisions about their portfolio. The advantage we have as candlestick investors is we can see exactly what the investor sentiment was at those levels, either as a resistance level or breaking out through a resistance level. The important one that we trade with is this black line, which is the 8 exponential moving average, which we call the T line. And a very simple rule, if you see a candlestick buy signal and a close above the T line, you can stay long until you see a candlestick sell signal and a close back below the T line. With the caveat that the further away you move from the T line, the higher the probability it's going to come back and test it. So if you start seeing selling and you're that far away from the T line, that's when we flip to our 10-minute chart and start taking profits. So somebody was also asking how to handle your stops on your option purchases. Your stops are not based upon the price of the options. Your stops are based upon what the chart is telling you of the underlying stock. That's why you are buying or using the options to buy that underlying stock. Options are just a method for getting into a position with more leverage. So when you're buying an option, it's because the underlying stock was telling you it's time to buy. When the underlying stock tells you it's time to sell, that's when you close out your options. Or if a price of an option comes back down through a certain level, and that would be your stop to get out of the stock, then that should be the level that you get out of your options. Do you care about volume? Yeah, I do care about volume in the sense that the smaller or the lower the volume of a stock, usually the lower the volume is going to be on the option, which is kind of obvious. So if I see a stock that trades 240,000 shares a day on average, it may not have a whole lot of option activity. And we'll get to some of the option charts here to show how you can tell whether there's a lot of activity in that option or not. But essentially what we're looking for is the timing to get into a trade. And we know that the timing is based upon what should happen at the resistance level and at a pattern breakout area. Trading 20-minute binaries, there isn't the luxury of gaps. There are unbelievable spikes. That could be. I don't trade the binaries, and it's not that. Yeah, when I say I don't trade the binaries, is I trade a bunch of stuff, probably too much stuff. That the place to be talking about different option strategies or trading different things is in the options room. That's where everybody else is trading and give you a much more clear answer and what or prospect of what you should be doing. So anyways, there's the breakout. You can see the resistance level. You can see where the breakout occurred on the fry pan bottom. So when we see breakout gaps, that becomes a new dynamic in the chart telling you this is a good time to be trading the options. Now, if this was only happening a week before expiration, it might be a spread, anticipating it's going up higher. If it's 3 weeks beforehand, you might be more apt to be buying in the money calls with the expectation you're going to make a decent profit. If it's 5 weeks out, you might be buying out of the money calls, knowing that you have the prospect of a big price move that could make those small priced out of the money calls expand much greater. So anytime I see a gap up, notice how we had kind of a shooting star. But remember, a shooting star occurs when we're in the overbought condition. This was the breakout. So what do we look for? Kind of more of an inverted hammer. If they open up positive the next day, that tells us the profit taking of that day is over. We should have a strong price move. That's when I start looking to see what option strategy I want to start putting into place. A breakout right at a major resistance level. This is your ultimate trading point. Now remember, a lot of people get confused and say, well, you always tell us that we want to be buying when we're in the oversold area. That's true on a signal. When you're trading a pattern like a fry pan bottom, you're usually going to see the breakout occur when you're already up in the overbought condition. What weight do you give on volume on a gap? Oh, I don't build it in, but more than likely, if it's gapping, the volume is going to be increasing by itself, so it doesn't become a factor. Yeah, volume on a gap really doesn't mean all that much to me. Are you using daily charts for your options, candlestick reads? Yes, and that's again up to each individual. Now, I don't day trade options, again, because I don't have the time to sit and watch them. So if I'm doing an option trade, yeah, it might be because I'm a swing trader, I'm going to be using daily charts. If you're more of a longer term trader, you might be using weekly charts. And I don't know how to address whether you're a day trader of options. Well, I shouldn't be. I'll show you a few situations where day trading options come into play, but they would be also the setups for a swing trade as well as a day trade. Larry, you can't. What you have to do is make your decision of, obviously an option price is going to move with much more volatility than the stock price. So basically what your strategy has to be is I'm going to buy a call where I know the probabilities, or I want to buy a bullish spread where I know the probabilities based upon the chart pattern is moving in my direction. That doesn't necessarily mean I can get the best option price for it. And as we go through some, I'll show that there's a lot of times where if it's not a high volume option trading a stock with not a whole lot of option trading, your bid-ask spread is going to be fairly wide. So you have to figure out where to put your bid in to get into a trade. So the volatility, obviously, yes, you've got the volatility on a lot of options that if you're buying an option where it's bidding 120 and they're asking 145 and you get in at 135, then you decide immediately you want to get back out, you might be getting out again at 120. You're already down 10% on that trade. So the bid-ask spread is also a function of part of whether you get into a trade or not, based upon what is the magnitude of the price move of the underlying stock. Mark's question is, do you still buy if a market is overbought and going down, but individual stock charts show a breakout as possible? Again, if you analyze that as being the case, then you know that if you enter that trade, you better be a little bit more nimble, knowing that you're already up in an overbought condition, let's say in the market in general. And we'll kind of go through that when we go to the live charts. Let's see, how many more do I have here? So anytime I can see a breakout area, and knowing how much time I have to expiration, if expiration for, where are we? One in August. If August expiration was right here, I might have a different strategy than if August expiration was over here. One might be a spread. The other one might be buying the calls outright. Oh, the other indicator below my chart, these are stochastics. Stochastics set at 12.33, and very simple logic. The Japanese rice traders say if you see a candlestick buy signal in the oversold area, more than likely you've got a reversal. If you see a candlestick sell signal in the overbought area, more than likely you're heading down. Was out in the yard spacing it. You got me there, Jamie. Are you using the 3T line as a signal or heads up as the price moves from the T line? Doug, I usually use the 3T line. It's not as relevant to me. You use the 3T line crossing if the candlestick signal is telling us it's crossing. So, but when the 3T line does become more important to me is when you start moving too far away to the upside or the downside of the T line, then the 3T line becomes more relevant. And on some of them, you'll see the light green line of the 3T here. So anytime I can see patterns, that tells me I'm get ready for an option trade, depending on the time magnitude. Again, either a spread and or there was only 1 week left to expiration, I might be doing a credit spread because the probabilities are in my favor. In this situation right here, if it broke out and I had 4 weeks to expiration, that may only warrant just doing the calls outright. Let's see. After a gap up, do you wait for the next day for the pullback to get the call option at a lower price? No. I'm not trying to get into, and a lot of people say, shoot, this has been a good price move. I'm going to wait for it to pull back so I can get a better price. Now, you got to think of the logic of that. And I always bring this up quite often because that question is asked quite a bit. If you're buying based on the confirmation of a buy signal, what do you want to see after that? You want to see the bulls are taking control. If it's pulling back, what's that kind of telling you? That the bulls might not have as much strength as you would like. So if you're waiting for a pullback so you can get in, what's your thinking? Your thinking is, all right, if they pull this back, it's going to give me a chance to get in. And as soon as I get in, I'm going to have the immaculate execution, which means as soon as I buy it, it's going to turn right around and go back up again. That is the wrong, to me, that is the wrong method for entering a trade. Now, there are times where that becomes true. For example, if I just had a big breakout through the 50-day moving average, and the next day it opens flat and starts pulling back, I'll see if it pulls back to the 50-day moving average. And if it does, then I'll flip to my 10-minute chart and see if the buying starts there. That, after yesterday's buy signal, that consolidation is not unexpected. Now I can maybe buy it at a little bit better price. But if I'm in an uptrend and a price move is already being made, yeah, I'm not going to wait for a pullback, because if they're pulling back, it's pretty much telling me that price move isn't as strong as I wanted it to be. You show an example of an option chain, how you set up. Yes, Eric, we're getting to that. What screener have you found best to get the right trades? Oh, Alex, I don't use screeners, but that is a question to put in here to ask other people that I use them. William, that's also a function. Again, these are all details that we were going to go into with much more detail, I guess detail with more detail, of when do you use in the money, at the money, or out of the money? When do you do a spread? When do you do a credit spread? I'm just kind of going through the general of all this, that the advantage, and the first advantage is that we can have a high probability profitable trade based upon the analysis of the chart. Then there's very simple trading strategies that can take advantage of those price moves. So what we first want to do is identify which price moves and where are they most effective, like the bobble. When it fails at the 50, pulls back. Notice how it didn't move away from the T line. This move right here tells me this is time to be buying whatever time frame I have. Might be calls outright, might be a spread. Yes, the conditions of the market do have a weight or what do I say, an effect on how heavy or how many option trades do I want to be in. might not want to be in very many on the long side with the market in the overbought condition with some indecisiveness. And that's when we do the live charts, we'll kind of go into that a little bit more. How do you determine to buy at that breakout point, though it's already at the overbought condition? Because, Anton, just as I said earlier, there are times where you want to be buying the signals when everything's in the oversold condition. There are times when you want to be buying pattern breakouts, and more than likely you're already going to be in the overbought condition. And that kind of comes back to the basic of candlestick analysis that the Japanese race traders produced for us, which is, where do most people buy? They start buying exuberantly at the top. Where do most people sell? They panic sell at the bottom. And so the pattern is usually just an indication of when investor sentiment is building up for the next big price move. Okay, yes. Yeah, these are just to give you examples. We're going to go to the live charts here in a little bit. Let's see. And so whether and the live charts or the current charts don't mean a hill of beans, as far as, or as I should say that the other way. Past charts don't mean a hill of beans as far as being credible or not, because you could be looking at this chart. This chart could be a 1-minute chart, a 10-minute chart, a 30-minute chart, a monthly chart. This chart could have been from a year ago, 5 years ago, 2 months ago. The thing that remains consistent, no matter what chart you're looking at, is the patterns are all the same. Human nature does not change. They haven't changed for 400 years. They're not going to change in the next 400 years. If a gap up fills a prior gap down, like today on IBB, would you be less likely to trade even though it broke the 200? John, ask that again when we get to the live charts. Sonia, usually we have to answer the questions as we go through, but don't worry. The progress of my fast-moving presentations are always slow, so don't worry. So if we see a breakout level on a pattern, kind of your J-hook pattern, that's when you want to be buying. What we're looking for is, notice our doji sandwich that broke us out of this slow curve, this confirmation that we've got more upside, or a gap up to the resistance level, and then a gap up through the or past the resistance level, or our best friend signal. Now again, notice where this broke out. Your stochastics were up here. Notice where our best friend signal occurred, when our stochastics were down here in the oversold condition. I'm typically basing my swing trades off the daily charts, yes. That doesn't necessarily mean that it's not going to turn into a day trade, or my swing trade time frame is flexible. It could be 2 days, it could be 10 days, and if it ran for 30 days, it's going to be 30 days. So I'm looking for those breakout gaps. If I know what to expect after a breakout gap, which is our 45 degree, right in here, that's a different option strategy. That might be in the money, knowing that it's going to be a steady Eddie mover, that I don't want to be too far out of the money. I want to just see what my in the money call is going to do from there. So what we'd like to teach people is with the big gaps, what do we do? First of all, we want to see what creates the big price moves. And again, it only takes one trade like this every 6-8 months, that you're buying calls when the stock is at 15, and 2 days later you're getting out of those calls when the stock is at 45. That adds a lot of value, obviously, to a portfolio, which now that money is now reinvested into patterns that are breaking out again with high probabilities. These are what we're looking for, the breakouts. what type of strategy would we put on here? If August expiration was right here, it'd be a completely different strategy than if it was over here. All right, let's go through a few more. The wedge formation. Another very highly effective method for getting into a position right at the right time, knowing that if it breaks out to the upside, you want to be long. Or like we saw in Nugget the last few days, where it was trading below the T-line, did a doji. This is where, if you're aggressive, you can buy way out of the money puts, or way out of the money calls, because if it's going to break, it's going to break hard one way or the other. And that's just on the basis of knowing what should happen coming out of a wedge and where are you in respects to the T-line. So today, SRPT, we recommended if it traded positive. That's right. But we also know what our other trading strategy or pattern setup could be. What's our simple rule of a doji? Well, if it opens positive, we know it's going to move in a positive direction. If it opens positive, we know we have a possibility of a doji sandwich, which means the magnitude of this candle will be the same magnitude as this candle. That might warrant definitely looking at the calls. Now, I'm looking at the calls, and I just screwed that up royally. Somewhere up here, where was the stock? Stock closed at 22.68. So somewhere right in here, I think this one was the 23. So we'd be paying $7 for the 23. Well, that's pretty hefty. Now, as I say, I usually wait somewhere to 2 to 3 weeks out before expiration. But if I see there's a good trade setup, oops, this was back to somebody asking for the ladder. This is what the ladder looks like, except I didn't put all the numbers on here. This might be 23, 23 and a half, 24, 24 and a half. So the ladders in the old days would have been 20, 25, 30, or 20, 27, 50, 30. Now they've got it down not only to the dollar amount, but even a $half amount. And that's pretty much because the volume and the interest in options has expanded so greatly over the last 20 years. When I was a stockbroker with Kidder Peabody back in 1976, 77 back then, options on individual stocks were just coming into play. And there was only a few of them at that time. So back to this one. If I wanted to get in maybe at $7, what's halfway? That's $1.20. $6.80, $7 would be where I could get in. But if that stock moved like we think it could, a 1.5 on a positive open tomorrow if the markets are heading in the right direction, that means that my $7 might go to $8.20. On the other hand, if I go and buy a 25 call and sell a 28 call for $1.10, well, now if that stock price moves up to this level, my $1.10 might move up to $1.60 or $1.70. So I've got much greater possibility of making 60 or 50% on my trade doing that spread versus, and also having a lot less money at risk versus buying the calls outright. So again, I don't like to buy spreads, but sometimes, remember, you shouldn't put on a trade unless it makes sense math-wise. That's the only reason that you're putting on that trade, is to make money. So a lot of people say, well, should I buy those calls Up here, you're buying the 23 and I think it was what did I say? 23s, maybe the 24s for $7. Well, that's a lot of money and a lot of premium for trying to make a profit off of that chart pattern. Might make some good money, but it's got to move quite a bit. Whereas the spread makes a lot more sense. So if it's 4 weeks out, I'd usually just buy the calls. But if the calls don't make sense, I'll move to the spreads for the percentage move. I'm looking for things like you saw an OPHT today, the last couple of days. Notice where it broke out, right where the pattern started, the fry pan bottom. Notice how it got there. Double doji, bullish confirmation. That was the time to be watching to see what happened at that breakout level. That could well be TZ because I can remember sitting in the Kidder Peabody office up on the 47th floor of One Shell Plaza in Houston, Texas, which I think was the highest office floor in the city at the time. And a few of the people trading options, which back then being a spry 21-year-old or 22 years old at that time, didn't really understand all the options. So now, is this a good option trade? Well, if we can factor this is wave one, we're going into wave three, there's still a lot more upside. But this is a case of where how active are the options? Well, if you can see there's a big bid-ask spread, that means the activity in those options aren't very great. What most brokerage firms do, though, is they give you what their bid-ask spread is of people in their organization. If I was going to buy the calls, I try to calculate what's the middle price and put it in at that level. If I get it, it's probably going to happen within 5 or 10 seconds. If I don't get it, I'll move it up a little bit. I'm trying to figure out what this would be. 50 cents on the 225. Put it in at 225. It sat there for 15, 20, 30, 40 seconds and didn't get it. I may move it up to 230. If it sat there for a little bit and didn't get it, then I close the trade because that means they aren't going to give me a good price. I'm going to be much closer to the 250 or 260 range, which means if all of a sudden it turned around and I had to get out, I'm getting back out near the 175 range. I've just made a big percentage loss on something that I couldn't get in and out of very quickly. So I'm looking for situations like a bobble breakout like we see in Restoration Hardware. If this opens positive tomorrow, we've got a doji sandwich, we've got a bobble breakout. That's the ones to start looking at the calls or a calls strategy. REGN, we know the J-hook pattern. We know if this is wave one, here's where wave three is. So we might be able to say, all right, we want to be buying, let's see what price here, buying these calls and selling these calls on a spread because we know that's where our target is. Frank, that's exactly right. But sometimes that wide spread, if you can put your bid right in the middle and they hit it right away, that means there's more liquidity there than you think. That's why I say if I put my trade in at the halfway point, or let's say just above the halfway point, if they're going to hit me, they're going to hit me within a matter of seconds. If they don't hit me and I have to move it up 5 more cents and they don't hit me, they say, this one's too illiquid, close out the trade. Louise, the J-hook pattern is one of the candlestick patterns. It looks like a J-hook. Prerequisite of a strong price move, a pullback, and then the J-hook, which tells you this wave right here and this wave right here will be pretty much the same. There's about 6 or 7 patterns that are very highly effective based upon what human nature does time after time. That's why we're looking at the patterns today, because that's what human nature does over and over. So if I'm doing an option trade strategy, I usually look to see what the market is doing in general. Are we still in an uptrend? Are we ready to head down? Are we choppy? Which patterns are setting up? And what's my projected targets on those patterns? So we're going to start going into trainings. And I guess that's part of the Bonanza package, which is the Pivotal Cash Bonanza, and I think it's kind of a dual membership. We've got people that do option strategies for us based upon the candlestick signals, and they do it with all their parameters. They've been successfully trading for years. They've taken our formulas or our patterns and strategies and then figure which is the best option trade for that pattern. And then we have the option room. As you know, we've got this room here, the major room, which we have usually 150, 170 people in there every day during the summertime anyways. It gets bigger in the winter. And then we have the options trading room, which is combined with the futures trading room, which is, again, using the patterns and then everybody coming up with different strategies to take advantage of those patterns. So there's the link for this special, and I guess take a look at it. Plus, you get a 30-day free membership trial to the option trading room. So with that, Jim, I'm going to close this down for a second and bring up the live charts. You distinguish between the different types of gaps. Yes, we've got 2 full videos on gaps at the top and gaps at the bottom. Okay, all right. So remember, if you see a candlestick signal in the oversold area and it's followed by a gap up, not only does that tell you that that there's been a reversal, but that reversal is going to be extremely strong. That's why when you look at our training videos on the different quantitative signals, meaning which ones are the most powerful or most consistent, the best friend, which is your doji in the oversold area followed by a gap up, not only produces a high probability that you're in an uptrend, but it also produces the fact that you're in a very strong uptrend. Yes, but so this is what your analysis should be. This is why we want to know what the nature of each signal is. Notice we have 1, 2, 3 dojis in the last week in the Dow. That kind of told us that up here in the overbought area that the conviction of buying had kind of waned a little bit, that more than likely we were going to come back and do some profit taking back toward the T-line. Kind of the same scenario, but not as dramatic on the NASDAQ. We're still in this uptrend, but we have the possibility of doing a couple of days of consolidation up here. Oh, the link doesn't work. Takes you to the webinar registration. Oh, man. Becky, can you figure that out? Oh, worked fine. Okay, try it again, Greg. All right. Oh, Gary, it all depends on the condition of the markets. Sometimes you'll get 2, 3, 4, 5 recommendations from our one group every week. Sometimes you go for a week or so without any recommendations, again, based upon what the market conditions are. Now, I try to get out a 1 or 2 options trades a week. And there's a lot of times where in the options room in the morning, I'll come in and say you might want to be buying XYZ because it's opening in the right direction today. And again, the options room is the same as the futures room. We do recommendations for both in that room. All right, let's take a look at a few things that we are recommending. Now the dollar, notice what the dollar did. It had the resistance here at the 200, fry pan bottom breakout. Remember what happens when they break out through a resistance level. They usually come back and test it. So we're going to be buying, especially if it comes back up through today's open. This is trading after hours. The fact that they broke out is a good indication that there's now a new dynamic in this stock. I've also been short hogs. Because notice every time it went sideways, it failed at the T line. Went sideways, failed at the T line. So at this point, we just stay short until we see a buy signal. The same scenario is kind of occurring over in the cattle area, where not so much the T line acting as resistance, but you can draw a line right down through here. You can draw a line, if you go back further, nope, maybe not that further. You can see you're pretty much in a downtrend. So there's a good possibility we're still heading down, and again, your stochastics is still heading down. So everything that we do as far as a candlestick chart is use the signals. What's the trend? What are your support and resistance levels? Sound is very patchy. Will there be a recording? Yes, this is being recorded. So I'll take a look at AVXL. Hold on for a second. And wheat. Wheat looks like it's in a bearish J-hook pattern. So we've got some shorts on this one, and we'll be going short, especially if it comes back down through this level. All right, I'm not going to do too many tonight, mainly because my spider bite in my elbow is acting up. It's back to being a toothache scenario. So right now with AVXL, again, remember, this started down, started back up. Now here's a perfect case of, there's your kind of your slow curve breakout. There's your J-hook pattern setup. So if you bought on this day, it needed to stay above the T-line, which it did. But you can see that our trajectory of a J-hook pattern is starting to disappear. So right now, you definitely want to have your stop at today's low. If it comes back down through there, it's not doing your J-hook pattern. That's why you want to recognize which patterns setups that you have, and then you also want to recognize when those pattern setups aren't in progress. Oh, Frank, if we are talking about shorting wheat, no, you just short wheat. It's or you buy cattle, you short cattle. It's just buying or shorting the contract. Let me go through a few of how you trade different big price moves. Cone, for example. Do you know to buy here? You buy here, buy here. Where do you buy this one if it's skyrocketing? And this is a perfect case of you go to your 10-minute chart. So this type of chart is what I usually use, especially trading futures during the day. But if I see a breakout like this, and then I start seeing selling, I'll take my profits and wait to buy when the profit taking's over. The reason for that is usually a big move like this, that's most of the move for the day. as you can see, right about in here was about where it ended up for the day. That was on cone. So again, down in here, as long as I didn't see there was any selling going on, I can be buying. Does that, if I buy right here, does that mean it might come back here? Definitely. But when I was buying, it was still indicating the buying was in progress. The T-line is the 8 exponential moving average. A very simple concept. If you see a candlestick buy signal, you can stay long until you see a candlestick sell signal and a close below the T-line, with the caveat that the further away you move from the T-line, the higher the probability it's going to come back and test it. So that means if you're way up here and you start seeing sell signals, the probabilities are there's going to be a turnaround. SPU, whoops, we're on the 10-minute chart. Kind of the same scenario. Had a big move up and then faded back. But you can see what happened when it came out of this fry pan bottom. It's run from 3 to 11 and got as high as 12 in a very short period of time. There was profit taking. And then notice the one thing they couldn't do. They couldn't close it below the T-line. And DAN, there's your gap up through the resistance level, through this level. If it opens positive, there's going to be a lot more upside. This is what's telling you there's a lot of force in this this uptrend. And OSG, I don't know why this is doing this. Something's wrong there. Flexion, same scenario. We can see the cup and handle. You can see the gap up, and we know the simple rule that if they open this positive, it's going positive, and if it breaks out through this level, we've got a potential another big price move like this with a wave 1, wave 2, going into wave 3. Oops. Oh, the S&P was following pretty much the Dow, which was the same scenario, that we're getting a little bit toppy up here. We haven't had a complete sell signal because we're still above the T-line. What are the sell signals you're seeing? The doji, the doji, the doji. Now we've got kind of an evening star signal up here. Stochastics in the overbought area. We know at least they're probably going to come back and test the T-line to see if that's going to act as support. Let's see. Oh, Kenneth, we can't figure out. There's nothing in there anymore. I mean, this happened 3 weeks ago. And now my elbow is aching like a bad toothache again. Let's see. Another one. ECA has broken out through this level after a bullish engulfing right off the 50. Stochastic still heading up, but notice what it did today. Did a lot of profit taking, and that was probably a function of the market selling off. But if it opens positive tomorrow, what's it essentially telling you? The profit taking's over. The breakout is still in progress. Wave 1, wave 2, and notice where wave 3 is starting. They couldn't get this back below the 50. Oh, did that have earnings today? All right. And Dish. This I've got on the chart or on the watch list right now, because notice all the parameters that this one produced as far as showing buy. Opened right on the 50. Traded down. Did a big bullish engulfing, belt hold, left-right combo. If this opens positive, you know this pattern is in progress. Another move capable of doing the same magnitude as this moving. Did that one have earnings today also? All right. So somebody was asking, does the movement based on earnings mean anything? And the answer is yes. Remember, the signals are the accumulative knowledge of everybody buying and selling. It doesn't matter what the reason is, or because of the uh, darn, I forgot what I was saying. That's just fine. Howdy do. Maybe it's these ibuprofen pills that I have. Forgot what I was even saying. That's right, senior moment. This one I was bringing up because notice what it did coming out of the patterns. Move, J-hook pattern, gap up through this level. So now what do we have? We're way up here in the overbought area, and we're seeing a shooting star. This is where you use your visual analysis of where should this not be trading tomorrow. Shouldn't be trading back below the low of today. If it does, it's telling us it's starting to back off. That's when you want to start taking your profits. And then you can just watch to see what it does once it does get to the back to the T-line. Yeah, I don't know. I've got them on some of the charts. Let's see. Well, maybe not. Sometimes when I freshen up the charts, get to put the 3T on there. But that is where the 3T would be effective. Is that the further away we move from the T line, the more effective the 3T line becomes. And there's your J-hook pattern. Notice you had a strong gap up, kind of a doji sandwich, and you broke out through this level. Now you have a bullish engulfing. So if this is wave 1, wave 3 should be the same magnitude. The 3T line is the T line is the 8 exponential moving average. The 3T line is the 3 exponential moving average. And again, it works as a faster indicator of investor sentiment when you start moving too far away from the T line. CarMax, another little J-hook pattern that if this opens positive tomorrow, you're still in wave 3. Wave 1, wave 2, kind of a morning star signal heading into wave 3. And WABA, this is what we call the bobble. Notice it came up, hit the 50 and failed, but notice where it failed to. It couldn't close back below the T-line. You have a T-line crunch, bobble. It broke through. Where do you think your next price target is? Up here to the 200-day moving average. Let's see. I have PII on here to illustrate the bigger the move, the more compelling you're going to have more upside. And Alaska Air. This is your perfect example of a J-hook pattern showing support right smack dab on a major support level. Remember, anytime you go up through a resistance level, they'll come back and act as support. We can see immediately that they act as support based upon what type of signals occur at those levels. So I'd be buying this one on positive trading with the factor that if this is wave 1, wave 3 should take you up to the 200-day moving average. They had earnings today also. All right. Okay. I'm going to do just a couple here. Oops. Whoops. This one with the gap down, remember, your best friend is a doji followed by a gap. That tells you there's probably a lot more downside. There's a gap to fill down here. Stochastic's rolling over. As a matter of fact, you'll probably see this one on the recommended list tomorrow for going short. What do you think of Delta big volume? Again, you've had kind of a dark cloud. Notice how they failed here at the 50, and then a gap down. And what is your overall trend on this stock right now? As you can see, it's down. So it got up here to the 50. Where do you think your next target will be? Somewhere down in here someplace. Michael, there might be, yes, I think there is a system where they'll trade the options automatically for you. Okay, I'm going to just do 5. Oh, MNLX had earnings today too. Then I'm going to go stick an ice pack on my arm. Stage stores, just stay long as it stays above the T line. It's doing exactly what you would just suspect. Came up through the 50, pulled back to the 50. So right now with today's selling, you're more apt to be in a steady uptrend versus a big move to the upside. CAFD, yep, you're in wave 3. You did a shooting star today. You're not quite in the oversold area, but if it opened lower tomorrow, I'd probably close out the position. Weibo, we own. You just stay long as it stays above the T line. Cypress needs to open positive and trade positive to stay in it. Amazon has been staying up above the T line. And what's the trend? The trend is up. The T line's been acting as support. So you stay long on this as long as it stays above the T line. Apple is probably the weak sister. It's not moving up with any great resiliency. And notice where it's kind of running into resistance, right where it ran into resistance before. If this closes back below the T line, you probably want to close it out. Gold did pop up today. And so the gold trust is sitting right here on the T line. Let me see what gold is doing right now. That's not the right chart. Yeah, gold came back up a little bit. Oh. Almost back to the trend channel, not quite yet. In front of the microwave, all right. AMAT has to open positive tomorrow to stay in it. If it opens lower, take your profits. All right, 3 more, and then let's go do something. EAM, emerging markets. Again, you stay long, but notice how it's getting a little bit toppy up here now. Let's make these bigger. Still use the T line as your stop. United, another one where you just stay long. Not real exciting to trade, but it's in a nice uptrend. All right, thank you, Kathy. All right, couple of the biggies. Microsoft had that big move. I would suspect it's going to be in a 45 degree. And then Tesla's probably not tradable at this point. I wouldn't be long, I wouldn't be short. As you can see, they're just kind of sideways at this point. I don't think it was a brown reclose. As a matter of fact, yeah, I went and got antibiotics 3 weeks ago when this first happened. I think it's bursitis that was probably kicked in by this darn spider or whatever bit me. All right, last one, LRCX. Those big bearish engulfing. So this has to open positive to stay in it. Okay, let's call it a night. Thank you for the medical advice. Probably if I just go drink a bottle of scotch, that'll make everything feel better. All right, everybody, and take a look at the special on the Bonanza. Got a lot of people that have been very pleased with it. So with that, everybody have a good evening. We'll see you bright and early in the chat room.